Welcome to the Deep Dive. Today we're getting straight into AT&T's third quarter 2025 results. We'll look at the numbers and what they tell us about their strategy going forward, all based on their latest reports.
Yeah, our goal here is to quickly break down the key financials, see what's driving customer growth, and really unpack these pretty huge capital decisions they're making for the near future.
Okay, let's jump right in with the headline numbers. Total revenue, $30.7 billion for the quarter.
Right, which is up about 1.6% compared to last year. Solid, but it did slightly miss the consensus estimate, just by a hair, really.
So a tiny miss on revenue, but what about profitability? How do the core operations perform?
That's where it looks, quite a bit stronger. Adjusted EBITDA, which is a good measure of operational cash flow, hit $11.9 billion.
Okay.
That's up 2.4% year over year. And the adjusted EPS, earnings per share, that came in at 54 cents.
54 cents, so flat compared to last year and pretty much what analysts expected.
Exactly, right in line. Which, considering the competitive environment, holding steady is, well, it's not bad news.
Now, anyone just glancing at the headlines might have seen a huge jump in the standard, the GAAP-diluted EPS. It was $1.29 versus a loss last year. That looks like a massive turnaround.
It does, but you really have to look under the hood there. That $1.29 is almost entirely driven by a big one-time gain.
Ah, the DirecTV sale.
Precisely. They sold off their remaining stake, booked a $5.5 billion non-recurring gain. So yes, it's real cash, good for the balance sheet, but it doesn't tell you much about how the actual phone and internet business is doing day to day.
Right. So for the ongoing health, we stick with that $1.54 adjusted EPS.
That's the number to watch for operational performance, absolutely.
And speaking of cash, that DirecTV sale certainly helped. But their underlying free cash flow, FCF, that looked pretty healthy too, didn't it?
Very healthy. $4.9 billion in Q3 alone. That's up 5.7% from $4.6 billion a year ago.
Almost $5 billion in cash generated in 3 months.
Yeah, and generating that kind of cash is, well, it's crucial. It gives them the confidence, the breathing room to stand by all their full year 2025 financial targets.
Despite some big spending plans we'll get to later.
Exactly. It shows they feel pretty secure about their execution right now.
Okay, let's pivot to the customer side then. Because strategy's great, but you need customers, and wireless looked like a real win this quarter.
Oh, absolutely smashed it. They added 405,000 postpaid phone net adds.
405,000, and the market was expecting what, closer to 330K?
Yeah, FactSet consensus was around 334,000, so beating it by that much suggests their offers are really resonating with those valuable, high-quality postpaid customers.
And that brings their total postpaid phone base to nearly 74 million.
73.8 million, yeah. A huge base. And you saw that flow through to the segment's financials, too. Mobility service revenue was up 2.3%.
And that drove similar growth in the segment's EBITDA.
Yep, mobility EBITDA grew 2.2%, so good flow through from revenue to profit there.
I did spot one, maybe slightly concerning metric, though. The postpaid phone-only churn, it ticked up a bit.
Good catch. It was 0.92%, up 14 basis points year over year. It's not a huge jump. A basis point is tiny, 0.01%.
But still, more customers leaving than before.
It suggests that maybe, to get those impressive 405,000 ads, they had to compete a bit more aggressively on price, or maybe promotions pulled in some customers who are more likely to shop around. It's a trade-off.
Management must think the volume gain is worth that slight uptick in churn.
Seems like it, especially when you factor in their bigger strategy, which is all about bundling or convergence.
Right, which brings us neatly to broadband. They've got the two approaches running side by side, fiber and this Internet Air thing.
Exactly. Two tools for different situations. Fiber is the premium long-term play. They added 288,000 net new fiber customers.
Okay.
That pushed them over 10 million total fiber subscribers. And the financials there are really strong. Fiber revenue jumped 16.8% year over year.
Wow, nearly 17%.
Yeah. And importantly, the average revenue per user, the fiber ARPU, also climbed 4.4% to over $73. So more customers, and each one is paying more. That's the ideal scenario.
But building fiber everywhere takes time and, well, a lot of money. So Internet Air fills a gap.
That's the idea. It uses their existing wireless network, fixed wireless access. They added 270,000 Internet Air customers in Q3.
270,000. That sounds like a big jump.
It is. More than double the ads from the same quarter last year. They're using it smartly, mostly in areas where they have good 5G coverage, but maybe haven't run fiber to the home yet. It lets them grab broadband customers relatively quickly.
So if you add the fiber gains and the Internet Air gains,
You get 558,000 total broadband net adds for the quarter, which, as the report notes, is their best broadband growth in 8 years.
so that dual strategy seems to be working pretty well. And this ties back to convergence.
Absolutely. The report highlighted that over 41% of their fiber customers also take AT&T wireless service. These converged customers are the holy grail.
Because they stick around longer.
Much longer. They're less likely to switch either their internet or their mobile if they're bundled together. That's why the CEO had that interesting comment about ARPU pressure being a feature, not a bug.
Right, basically saying if they give a small bundle discount, lowering the average revenue per user slightly, it's worth it because the customer stays so much longer.
Precisely. You sacrifice maybe a couple bucks a month up front, but you gain potentially years of stable revenue from that household. Lower churn, higher lifetime value. That's a long game.
Makes sense. It wasn't all positive news, though. The business wireline segment still seems to be struggling a bit.
Yeah, that's definitely a headwind. Business wireline revenue fell 7.8% year over year, and the segment's EBITDA dropped almost 13%.
Ouch.
It's mainly driven by the decline of older legacy services, things like old copper lines, traditional data services that businesses are just moving away from. They're growing in newer areas like business fiber and advanced connectivity, but
But it's not growing fast enough yet to offset the decline in the old stuff.
exactly. It's a transition that's still weighing on the overall results.
Okay, that transition leads us into the really big news from the quarter, the huge strategic investments they announced. Clearly, that strong Q3 performance gave them the firepower.
It certainly seems that way. They didn't wait long to deploy that cash flow strength. First, the really big one, the $23 billion deal to buy spectrum from EchoStar.
$23 billion in
Yeah.
cash. That's massive. What kind of spectrum is it?
It's about 50 megahertz nationwide of low-band and mid-band spectrum. Crucial stuff for 5G capacity.
So this is about ensuring their network doesn't get congested as usage grows and maybe helps expand that Internet Air service.
Both, absolutely. It gives them more highway lanes, essentially, for mobile data and for fixed wireless. It's a foundational investment for the next decade of wireless, expected to close in the first half of 2026.
And then there was another big acquisition, this one focused on fiber.
Right, the deal to buy Lumen's mass markets fiber business for $5.75 billion. Also expected to close early 2026.
And they have a plan to kind of offset some of that cost later.
Yeah, it's quite clever financially.
Huh.
They plan to create a separate entity, they're calling it Network Co., holding these acquired Lumen assets. Then, within about 6 to 12 months after closing, they intend to sell a partial stake in that Network Co. to an investment partner.
So they keep control, get the fiber assets, but bring in outside cash to reduce the immediate debt burden.
That's the strategy. Maximize the network expansion while minimizing the long-term balance sheet impact.
Speaking of the balance sheet, that $23 billion EchoStar deal alone must push their debt levels up significantly.
Oh, for sure. They acknowledge that. The expectation is that the EchoStar deal will temporarily push their key leverage ratio, net debt to adjusted EBITDA, up into the 3.0x range.
3 times leverage. That's getting up there.
It is higher than their target, which is 2.5x, but they laid out a clear plan to get back down to that 2.5x target within about 3 years.
Fueled by the expected growth from these investments, presumably.
Exactly, and fueled by ongoing free cash flow generation and cost-cutting efforts, too.
Right. We should mention that 2025 is still slated to be their peak capital investment year, around $22 to $22.5 billion, mainly for the wireless network build-out.
Massive spending.
Right.
But they're also focused internally on efficiency. They reiterated their goal of achieving over $3 billion in run rate cost savings by the end of 2027.
And how are they finding those savings?
A mix of things. Using AI for operational efficiency, streamlining processes, but also, importantly, continuing to decommission the old, expensive-to-maintain copper network as they shift customers to fiber and 5G. That saves a lot on power and upkeep.
Okay, so strong Q3, huge investments announced, cost savings plans. How does this all translate into their guidance for the rest of this year, 2025? Did they change anything?
Nope, they held firm, reaffirmed everything, which again shows confidence despite those big deals. They still expect mobility service revenue and adjusted EBITDA growth of 3% or better for the full year.
And earnings per share.
Adjusted EPS expected at the higher end of the $1.97 to $2.07 range. And that all-important free cash flow, FCF, is still projected in the low to mid $16 billion range for 2025.
So steady as she goes for this year. But the real payoff from all this spending and debt is meant to come after 2025, isn't it?
That's absolutely the narrative. That's the whole point, that they're forecasting a significant acceleration in free cash flow, targeting $18 billion plus in 2026,
Right.
and then $19 billion plus in 2027. That step up in cash generation is what justifies the near-term pain of higher debt and peak investment.
And earnings growth is expected to accelerate too.
Yes, they anticipate adjusted EPS growth hitting double digits by 2027. So a clear path laid out for significantly improved financial performance driven by these strategic bets.
And amidst all this, they're still returning some cash to shareholders.
They are. They bought back $1.5 billion worth of shares in Q3. That brings their year-to-date repurchases to over $2.4 billion under the current program, balancing investment with returns.
So wrapping this up, it feels like two main themes emerge from this quarter. First, solid execution on their core strategy, particularly that convergence model driving subscriber growth.
Yeah, proving the model works in the current market. And second, just these massive, aggressive investments in spectrum and fiber that are fundamentally reshaping their network assets for the future.
Laying the groundwork, basically, for that promised acceleration in free cash flow and earnings starting in 2026.
It all hinges on that future growth, which leads to, I think, a key question for you, the listener, to think about. We saw good subscriber growth this quarter, reliant on having fiber available. But given the billions they're spending now and the debt they're taking on, how critical is it that they actually hit that very ambitious long-term target of reaching 60 million plus fiber locations by the end of 2030? Is hitting that massive build-out goal essential to ultimately justifying today's huge financial commitments?
That 60 million fiber target really does feel like the ultimate benchmark for whether this whole grand strategy pays off in the long run. Something to keep a close eye on. Thanks for breaking down all those numbers and strategic moves for us.
My pleasure.
And for everyone listening, you can dig into the specifics of those non-GAAP numbers and the deal structures in AT&T's full investor relations materials.